Trump called it as the Liberation Day in US and introduced tariffs across the globe.
Something that we used to use at McKinsey, which the long form of which was pulled out of my ass.
The red line shows that Liberation Day announcement is the weighted average tariff on all imports. So it looks like we are back to like 1905 or Great Depression kind of era.
What really does he want? Does he want all jobs to go back into US? Is that his end game? One of the big shifts that has happened in this tenure is that they want a weaker dollar. Now, this is really their game plan.
He's actually, frankly, he's socially or culturally right, but economically and fiscally left.
Is that the moment now where, we should be like thinking about that this is our, finally the manufacturing breakout decade for us?
We have a billion plus population and a consumption place, which no other country can give. The Indian market, while exciting, it has got its own capacity constraints. I wouldn't be surprised to see trillion-dollar companies coming out of startups out of India.
Everyone, welcome to brand new episode of Asymmetric. This is episode 22. Unfortunately, we don't have Revant with us. He had a couple of emergency tests that he had to do, so he couldn't join us. But my usual partner in crime, Chirag, is of course here, and we have an incredible guest. I think just last night we had Trump reverse his stance on tariffs with a 90-day pause. So there's a huge amount of public market volatility, not only in India but globally. But I think more specific and related to our viewers in India, we do have a lot of questions on public markets, how new age companies are performing. Founders like Chirag, Revant, and I obviously always think about IPO, given we're all venture funded companies. We always think of taking our companies public, what's the right time, how to create value for public market investors. So this is a discussion that has been happening in the three of us as investors, founders, for ever since we know each other. And today we have Harish Krishnan with us. Harish is a heavyweight public market investor, represents the mutual fund mindset in asset allocation and risk management, and has been doing this for 20 years. And Revant and Harish are friends, and Revant speaks so highly of him. It's my my first time interacting with Harish, but such a privilege to have you on the Asymmetric, Harish. And thank you so much for being generous with your time, your perspective, and really looking forward to going deeper with you on India public markets, your view on new age companies, and what founders like us should look out for. Welcome to the Asymmetric podcast.
Thank you so much, Shantanu. I have followed you and your work, Chirag. Revant, of course, as you said, we go back to our institute, and so it's absolutely a privilege to learn from each other and to have fun. So looking forward.
I was telling Hari that it looked like the world knows that we are going to get one, super heavyweight capital market guy, and the world has transpired to, give us more fodder for this conversation. Last 1 week, look at global capital markets, the way they have, we were discussing that it's a little bit of a pity that our market is closed today. You never know what might happen tonight, and then all games are washed again. It's very, very interesting. I think let's jump into that only and get Harish's view. I'll just quickly, share a little bit of context there, and would love Harish to get some views there. This is what at least happened over the last 1 week when Trump called it as the Liberation Day in US and introduced tariffs across the globe. Right. Funnily, the formula is for reciprocal tariff is trade deficit with that country divided by imports into 0.5. Shantanu, isn't that a little bit of a, if you have to, borrow your word, it looks like a Puma metric to me.
Totally. What Puma means?
No, please enlighten.
Something that we used to use at McKinsey, which the long form of which was pulled out of my ass. I think very well applied to this chart.
Very interesting that, whole world is figuring out how much tariff is now applied on us. And then there are economists who are saying this, how did they arrive at this? This is absolutely absurd. all of that. And I think he's made some very interesting points around, look at the tariff levels. At least I got this interesting chart. What was at least imposed if I discount what happened yesterday? The red line shows that Liberation Day announcement is the weighted average tariff on all imports. So it looks like we are back to like 1905 or Great Depression kind of era.
Yeah.
Trump had already done it in 2018, so they were already here, and now it's here. Interestingly, I think what is being touted as that this leads to more employment, more manufacturing, or more a lesser reliance on imports for US. But I think this one very interesting chart, which showed that this was last time when they had made tariff imposition in US. Actually, some of these manufacturing industries which actually require a lot of people, actually the employment hasn't increased. So I am on one side perplexed that okay, what's the actual motive? Is it just is there a second order effect which we all are not reading? Is it got to do with, I'm hearing theories around that this is more got to do with that they have a large debt to be refinanced in the next 6 months, and hence they are trying that okay, can we get the markets down? Hence over time there will be more rush to deployment towards more bonds, hence bond yields also go down, refinancing should be easier. But I can tell you, I am no expert, and these are all theories. I'm also hearing that Trump wants to get elected for the third time, and hence he wants to pass constitution. It's not allowed, so he wants to change the constitution in midterm. I don't know, and I don't know, how far of this is stretched as an argument, or is just, one of those clickbaity headlines which we've been reading. But would love to get your perspective, Harish. That how are you, reading this overall global development, which has shook everyone across the globe, all countries, no one is spared. And how are you thinking? And then we'll get down to what's the impact on India. Is there a silver lining here? Is there an opportunity for India?
Great. I think, as you rightly said, this is the most topical topic that we can discuss today. Now, to say that we have an understanding of Mr. Trump will be the biggest puma that I can bring it out, right? But the point is that at least us market people typically go in with an hypothesis or a prior, okay, and that is the basis on which our decision making fulcrum is based on. Of course, can those assumptions or hypotheses get questioned, changed, etc., and then you move on, right? That's the way we work, because uncertainty is never new. Markets are always uncertain. You will always have new events that come and shape us, right? And how we think about it and how we react to them is what determines whether we do well or not do well. So that's as far as the philosophy behind thinking about Trump is concerned. Firstly, and the foremost thing is Trump is a businessman. He's had the same discussion even in the 80s, that even in Trump 1.0, there's been a hike in tariffs that he's, right? But it didn't have its impact, whatever was its desired impact. I'm leaving that aside. And as you rightly pointed out, there's been no real manufacturing growth or worker growth which has come through, right? So what they are trying to do is basically get a stranglehold on China. Okay, what Trump has done on Liberation Day is basically he's done something very unusual, and of course there is this crazy formula that maybe a sixth standard student has come out with, but what he's brought in is the fear on all Asian currencies or on all Asian countries. Right, he slapped all the Asian peers more specifically, and while everybody has also got tariffs. Okay, specifically to Asian countries, he's made his displeasure known by very high tariffs. The second thing is that retaliatory tariffs, he's kind of further up the ante and further kind of spooked them. What that has brought in is almost all other countries have kind of said that okay, we're going to wait it out. China is the only one which has gone head on. The European Union was the other belligerent one, but they've also kind of said that we'll wait out. And of course, since yesterday's development, possibly they'll wait out even more. Right. So first thing is that now it might seem very unlikely that you're going to see transshipment of volumes coming in from China to any other country, which then gets moved on to US. So that I think is one approach that he's kind of done very differently from them. Okay. The second thing that he wants is a greater amount of spending on defense by European Union, and clearly through all his actions and whatever he said, and we've seen this mega shift happening out of Germany, which has been reasonably fiscally constrained all this while, who've now gone and done a massive U-turn in terms of spending as far as defense is concerned, right? Now coming to what really is potentially the likely end game. And this is the end game which is quoted both in Stephen Moran's paper as well as Mr. Scott Bessent in his interviews, where they actually give how much they expect from tariffs in terms of the dollar value. And if you were to back calculate it, that number roughly comes anywhere between 7 to 15%. Right. So this is the range of tariffs that eventually is going to settle at. So it's not going to go back to those good old days where US had, almost 50% of its imports, which were duty free, etc. There is definitely going to be a lot of bilateral treaties, but it's not going to be at these current levels, which are very, very high, wherein, everybody is wondering what to be done. Yes, there is going to be a shift out. Now coming to your point as to, what really does he want? Does he want all jobs to go back into US? Is that his end game? Now, if you think about the absurdity of what US or even to a certain extent what Europe is going through, the reality is that the number of hours worked by a European or by an American is at least 30 to 40% lower in this generation compared to the previous generation, right? So it is not that anybody is really waiting out to say that here is a job that I want to do, I am waiting to do it, and do it, right? So that's point number one. The second point is, let's look at some absurd trivia or absurd math, just to try and call out this hyperbole. Right. So he's got, say, Bangladesh is a garment manufacturer, and because of various treaties and duty frees that they have had historically, as being part of a poor country, they've got these concessions to both Europe as well as to the US. Right. Now, Bangladesh is roughly about $8 billion worth of exports of textiles that go into US. That's roughly about 20% of all the exports that it does. Go into US. So that is Bangladesh. Roughly about 1 million workers in Bangladesh work for this output that goes into US. Okay, so 1 million gets them $8 billion worth of foreign exchange from the US. That is the Bangladesh math. Okay, so if you look at, say, the example of tariffs and what really his end game potentially is, it is not that he wants all manufacturing to be happening only out of US. Again, please remember that he's a businessman. Okay, and when he was a businessman, he used to have clothing lines in Macy's, etc., wherein the shirt was made in Bangladesh, the tie was made in India, etc. So it is not that he doesn't understand that things are made cheaper in less developed markets than in markets. Now, just to kind of stretch that argument in terms of real numbers, okay, Bangladesh exports about $8 billion worth of garments to the US. Okay, and they've got roughly about 1 million workers who actually do this work for them, which goes into US, right? Now, to get the same efficiency of Bangladesh, let's say an example that 1.5 million workers in US have to do this job. Because Bangladesh, there is a learning curve. As founders, you know it best. And I'm just saying that 50% more will at least get them that equivalent. Now, if you say that 1.5 million work,
just to interject, I think you are being generous by saying 50%.
Yeah.
My sense is you only mentioned that number of hours. There is another cut, that willingness to work.
Absolutely.
If you apply, I think it's going to be 10 times, 20 times more people.
True. I mean, but just see the absurdity that comes even with, say, 1.5 million workers, right? If they have to be paid the lowest minimum federal wage of 7.25 cents an hour, okay, just the labor cost for this output would be close to about $40 billion. Okay, just the labor cost. What they are currently getting is just not the labor cost. They're getting the conversion cost, the energy, the power that gets used to it, the cotton, the actual fabric, all of that put together at $8 billion. Now, it doesn't require anyone with any amount of intelligence to say that this is not the end game. It's not that they want all of these jobs back in the US. It is just to ensure that you are not going to see transshipment, okay, which is happening, that they have put across all countries. The second thing, and this is a very big departure that we've seen, and this is outlined again in that Stephen Moran paper in November, is that one of the big shifts that has happened in this tenure is that they want a weaker dollar. Now, this is really their game plan because historically, like I said, whenever tariffs were levied, you would have that country's currency actually depreciate, okay, negating all of this. Okay, what he's kind of done through this spook and scare kind of a thing is he's basically now saying that even the dollar has to weaken. Okay, and so they are wanting what they popularly say a Mar-a-Lago Accord to happen. Now, whether it succeeds, not succeeds, I probably think that it's got a very low chance of success. But what they want is actually a weaker dollar. Okay, so the effective end game to my mind is not that you're going to see a manufacturing renaissance with number of workforce increasing. That is not what I think they want. What they want is something else altogether, which is over the course of the next decade, okay, you've got roughly about $100 trillion worth of investments that are needed. Okay, this is in factories, buildings, etc., etc. Today, US gets about $3 trillion a year in terms of new investments that happen in their economy outside of residential real estate and all that. I'm saying in terms of, say, productive kind of investments in terms of data centers, CHIPS Act, this, that, and everything, factories, right? Now they want, and China is already higher than that, at close to about anywhere between $4 to $5 trillion. This is their bigger worry, that they don't want this race to continue, wherein they are lagging behind China in terms of new investments. Okay, and therefore they want to get a greater share. So what they are wanting is, instead of 3 trillion, can that become 4 trillion or 5 trillion over the course of time on an annual basis? That is what he's wanting as a big success. So I don't think that they want so much that all the low paid jobs come to US. They want a certain critical mass. Of course, they also have a certain desire that basic commodities they need to have some control on. They need to have some control on shipbuilding. It's a very big focal area that has come through. And there was also this other tariff which has not got discussed at all, which is on shipping. Any ship that is made in China is going to pay a tariff from April 15th if it lands in US. So I presume even that is going to go away given the state of things. But they've got a very specific endpoint, right? So this is what we think is potentially his endgame. Now, of course, like I said, this could be a very stupid summarizing of his thing. Maybe reality is far different from where it is. Okay, but this will have meaningful consequences, not in terms of volatility of stock markets, etc. Right? See, man-made reset buttons typically lead to a massive shift. Okay, so we've gone through a very big man-made reset button in India, which is the demonetization. Okay, and while there were multiple reasons which were flouted, saying that this is what we'll achieve, etc., and I'm not going into the moral fact whether it achieved, not achieved. The one thing it has achieved, which is a mega trend, is formalizing of the economy. We've seen a massive shift in formalizing of economy, and it has got its own payoffs and its own productivity benefits, blah, 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 right? We're going to see something come through even with these Trump tariffs. It is not that the world is going to come to an end or all trade will collapse. None of that. Of course, all of that will happen in, say, 1 quarter, 2 months, 3 months, etc. All that is possible. That could be a confidence reduction, etc. But I would think that, the end game is actually a lot better. There is going to be actually a massive amount of investment. We've been big beneficiaries of the last 40 years. When I say we, I'm saying the financial markets, because there's been a lot of money which has got channelized into capital markets. It's become far bigger. And when Mr. Besson says that Wall Street has had a great 40 years, it's Main Street terms. Of course, that's a nice populist way of capturing the vote bank, etc. But even leaving aside that, I think there is a lot of merit. to believe that on the ground, real economy, there is going to be an investment boom that is going to happen. So, if you miss out these 1, 2, 3 months of what is likely to happen, and there are going to be some big shifts happening. The biggest shift that I would want to reach out is where I see the currencies are going to settle at, because that is the big tectonic shift that's going to happen. Okay, maybe in 3 months, 6 months, but post that, I would think that we can see actually a very different kind of a mega trend happening. I'm personally very optimistic about India in this kind of a scenario. We played a lot of cards right. We are right in the slot. Of course, there will be some concessions that we'll make, but I think this is possibly one of the best opportunities that are going to be ahead of us. And so I view this volatility or this madness very, very favorably. It gives us an opportunity to buy these stocks or buy the companies and businesses that we love at a far cheaper rate. Sorry, it's a long winding thing, but maybe Trump could have said it far simpler.
I agree with you. It's a fantastic synthesis, and you're right. I think Trump has been consistent on a lot of these positions. I think his approach is a little megalomaniacal. I think it's 2 steps forward, 1 step back. It seems like he's kind of winging it a lot. But even, for example, a weaker dollar, he's been saying it for 40 years that he wants a weaker dollar to increase exports. And he's always said that China has manipulated currency and weakened the yuan artificially just to make their exports easier, and wants US to compete. And frankly, I think if you look at EV manufacturing, China has an ability to just establish and invest in manufacturing to cover global supply in like one shot. That's what they've done with multiple, chemicals. They're now doing it with EV. So if you don't stay competitive, and then it's very likely that the trade deficit continues to balloon for them. And I see the position from a consistency lever as well.
See, it is not that, and this is, I'm just bringing in the market response function. Okay, many people, kind of think that oh, every day we have to look at X and see what Mr. Trump has tweeted, and that will determine how markets move. Now, people think that by being such unchecked power, he can do anything. The reality is actually quite different. Okay, the reality is there are at least 2 or 3 big sources of power that are going to check him out. The first, and that we've already seen, is the bond markets. The moment the 10-year paper goes anywhere close to 5%, because 5% is technically the nominal GDP growth rate of US, then it becomes a debt spiral. Okay, and they are very, very afraid of it, which is why they are doing everything in their mind to placate the bond markets. So that becomes the number one thing, right? The second thing is that you've got, while today he's got the absolute majority in the Senate and thing, but they'll go into polls in a year's time, right? And in a political establishment like US, you've generally got the party which is a lot more powerful than the president, right? And see, you've in which case won all the hardliners. The ones that you have to win have to be the moderates. Okay, so going forward, he will have to appease more and more on the moderates. So the first 6 months is the maximum honeymoon period where he can do anything. Post that, markets will figure out how to deal with it. Okay, so it'll still have its share of volatility, but it's not going to be that we will be completely caught in by surprise by what all he can do. So at least that's the way we think about it when we think about this uncertain variable called Mr. Trump, who's come into our lives back again, since October of last year.
Oh, very interesting. And sometimes I think about it, right? Like, for example, Elon Musk, Bill Ackman, all these biggest supporter, billionaire, entrepreneurs and fund managers, suddenly over the last 2-3 weeks, suddenly came under serious pressure. I think also assuming their AUM started tanking. I think Musk lost like $130 billion of personal wealth. And I sometimes think about this, right? Like, we simplify political positions very easily with one right-left spectrum. If we look at Trump, for example, his entire vote base is like working class America. It's working class America, right? It's not rich people. And he's actually, frankly, he's socially or culturally right, but economically and fiscally left. He wants to weaken the dollar, increase exports, get more jobs, etc. And this might actually be in against the interests of people who have funded him, or his billionaire friends who he plays golf with at Mar-a-Lago, right? So for him to balance this is super important, and for us, like I think people who read markets, invest, etc., it's important to understand where his end loyalties might lie. You're right, he's a businessman, but I think he's a majoritarian businessman almost, right? Where you have to now cover for like 150 billion.
Oh, well put. Yeah, that's a nice term. I see the reality is, and see, we are armchair analysts or thinkers. You guys are businessmen. I don't know whether you can ever be a populist businessman. Businessman is all about taking tough decisions, right? So, how long can he stretch this thing of playing golf, appearing as a billionaire, and yet caring for the masses and all that? It's an incredible balancing act.
Yeah, absolutely. It was a very, very, very well articulated synthesis. So good to hear, very positive local position from you in terms of good for India. I agree with you. I think India has been very mature and reasonable, and I think with Mr. Jaishankar, I think also very vocal compared to previous powers about what our position is, what our what our global relationships look like. We always used to be like a little bit behind the curtains in our diplomatic outlays, but I think now we have been a lot more vocal, and I think the Prime Minister's natural tendencies also are kind of more outward looking, global in nature. So I think you're right. I think we've played a few of the cards.
And if you really think about it, this has been our pitch book or our playbook for decades, that we want a multilateral world. We think it's become unipolar or bipolar, etc. We want bilateral treaties. We don't want to be hostage to it. Essentially, it appears that Trump is following India's playbook. Right. So we are actually way ahead in this thinking, in this mindset. Of course, they may be able to execute it far better. Thinking is one thing, strategy is one, execution is another. Okay, but this has been our position all throughout, that each country is different. You can't be hostage to some quote unquote principles to say that this is the right and this is the wrong. Everything is a shade of gray. Think of it from that perspective, and you'll US has always kind of taken that position that we stand for these principles, we'll never compromise. And here is somebody who's saying that boss danda important hai. Okay, the compromise, yes, there are certain values that we stand for, but I'm not going to prophesize and tell you what you should do. Neither am I going to be involved in every conflict. These are things that are wonderful news for India, I would say, from a geopolitical setup. I'm no geopolitical expert, but I'm saying that this essentially plays into our playbook.
One related question, Shantanu. I think maybe moving what he said about India, I think we are reading that looks like India is going to become even more manufacturing hub for Apple, with tariffs being put on China. What all, or is that the moment now where, we should be like thinking about that this is our, finally the manufacturing breakout decade for us is here. At least tailwinds look like in our favor. But is there more to, reading that headline, or, India needs to do a lot more to become a manufacturing powerhouse over the next 5 years? But is that tailwind in the right direction? For example, what we were discussing, Bangladesh has much higher tariffs. Vietnam has much higher tariffs than us. China, of course, is much higher. What it means is that it should be sweeter for India. Net, even if our manufacturing is expensive, does that mean that the overall opportunity in front of us is even more now?
So I think there could be a shade of truth there, but I'm not one to believe that this will change the entire opportunity set. See, if you are Apple, Tim Cook, you'll be very worried. Today you may say that okay, you've kept China. Tomorrow, what is it to say that you will not do against India, for whatever be it, right, or any country? So it is not to say that somebody's loss is only our gain. Yes, it's a relative world, but we need to stand on our own strengths rather than celebrate others' failures from that perspective, that just because unka tariff rate higher hai to apne paas automatically business aayega. That's not it. But I think we have genuinely a big advantage compared to most other economies. and that is that we have a billion plus population and a consumption place which no other country can give. Okay, and therefore our deal has to be the most sweetest of all deals, if you ask me. I mean, because all said and done, if you have to balance the deficit, okay, yes, we've got. I mean, think about Vietnam. I mean, they've got such a huge deficit or a huge surplus into. Now, given their population, given their state of economy, etc., what can they take from America that can offset that huge deficit in a reasonably short period of time? The answer is not much. I mean, whereas what we can do, we can buy, say, gas, we can buy defense. That itself is good enough to take care of a lot of our requirements. But more than that, and these are transactional, I think the chance that we are going to allow you access to a billion plus population consumption market, which nobody else can do, is our biggest trump card. So we will have to really be seen from that context, and not just from the context of saying that can we balance the deficit. I don't think that it is in their interest to balance the deficit either. I mean, what is deficit? At the end of the day, deficit is because US is consuming more than what it can produce. Are they basically saying that they should consume less? The answer is no. I mean, the citizens will revolt that. If I have to say that I have to consume $3 trillion lesser than what I was consuming in totality, I mean that's like a massive contraction. So I don't think that is in their end game either. It is about access to places, getting preference. So I would really be disappointed if our bilateral treaty is just like it is with, say, the Japan or the Koreas. Or I think it has to be one of the best or the sweetest deals, in my opinion.
Very interesting. Very interesting. Harish, I think changing gears a little bit into more new age IPOs in India, and how, like, from a more domestic standpoint, I think I think COVID was a similar won't say man-made reset. I think that'll be a sharp characterization of it, but it was in a way like we ended up closing a lot, printing. I think the US printed $3 trillion, interest rates crashed, and eventually what we saw was like a deluge of capital, which led to like a certain amount of hubris uh, in in um, uh, in the private markets also. And IPOs in 2021 were obviously like driven a lot by optimism then, and narratives and stories, rather than core business fundamentals. And the belief was that over a period of time, this is India's age, and the businesses will catch up and create a lot of value for public markets, right? I think 2021 IPOs, you would like to get your view on how they have done, and what looks forward. And of course, some of the big ones where there was like obviously Nykaa, Paytm were the more talked about one, but also Policy Bazaar, Card Trade, etc. Like a lot of these companies kind of went public, and then we had like a small amount of muted 2022, but then 23 again we saw, I think, Zomato. Following Zomato, we had Swiggy, which went public. We had a few smaller companies like MobiKwik in the fintech space. We've had logistics companies like Delivery, which just acquired another darling at one point, Ecom Express, but at 1/5 their last valuation, right? So I think a lot of Indian venture funded new age companies, which kind of built sizable businesses, took them public, and rightfully so. I think giving your venture investors returns, IPO was a good way. I think public markets also showed a appetite for high growth companies where profitability was more in the future, and so on. But how have you seen the response? What is your overall view on what has happened, what's not happened? Maybe break it by sector, industry, and as you are a CIO for a mutual fund, so again, you think about asset allocation and resource allocation very differently.
Sure, sure. This is something that can go on till evening, I guess. Uh, because this is close to your heart. You run so many startup businesses, and this is also close to our heart because we are truly excited to partner with many of them. There is a lot of value that we think that agile businessmen bring if done well. the last three words are very important if done well. Now, I'll just start out with Shantanu's point of 2021. Just to again point out the absurdity that 2021 was from a data point. Okay, so if you look at all the listed companies at that point of time, and again, my numbers may be a bit off, but they do capex at that point of time in 21 of roughly about all the private sector listed companies who are doing capex of roughly about $70 billion annually. Okay, that number has since grown. Okay, just to get you a sense as to how much venture capital money was pouring in at that point of time in September of 2021, the last 12 months preceding that, checks of $75 billion had got cut in India to that. I mean, so just trying to give you the contrast, right? These are businessmen listed. Of course, you can say that, old age companies, blah, 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 the Tatas, the Birlas, Reliance Group, all of them, right? And they were putting in close to about $70 billion on the ground. And there were money to be made on money, side deals or, etc., with which bankers in Mumbai and Boston and God knows where else, and definitely Japan was there with Masa-san also, putting in $75 billion at such short span of time. And there is a capacity to absorb money, right? You cannot, you cannot create out of thin air value. You can keep inflating it, and it has had its own perverse consequences, right? So that's one point that I want you to think about. That what really is the capacity of private sector or unlisted India. While we can keep talking about TAM and how big, and and you've worked in McKinsey, and I'm sure you have more jargons to pull out there than I can even think of. But the reality is that the Indian market, while exciting, it has got its own capacity constraints, right? And therefore, while there is definitely a blitzscaling that few companies have demonstrated, no doubt. In a matter of 5 years, 6 years, our food habits or eating out habits have changed so dramatically, built by Zomato and Swiggy, and before them, at least 4 or 5 other startups also came to try and evangelize that habit, right? So I think that it's been an incredible kind of a thing. But one shouldn't be thinking that everybody and anyone will be able to pull that off. So that is point number one. Okay. Secondly, public market investing is very different from private market investing. Okay, and let me try and get you some context as to why I say that. Okay. See, in private market investing, you've got your angel, you've got your VC, you've got your private equity, etc., who typically come in at a particular valuation. Their entire money comes into it. Either it goes into the company or it goes as a secondary, what have you, right? And so I know that a lot of founders, have got, because of the fact that, not everybody had so much of capital to start out with. And given the opportunity and the blitzscale opportunity, and the fact that if they don't do, some other competitor will get so much funding and then you will become irrelevant. So it's a catch-22 situation. I really empathize and pity these founders, but they end up having such small skin in the game eventually, right? 8%, 6%, 10%, blah blah blah, right? But more importantly, private equity or venture capital typically tends to come in with a large chunk of capital at one price point or at one valuation, right? And therefore, when I meet companies, who come in for IPO, they think of IPO as some kind of a celebratory end point. Okay, कि was मैंने करा दिया, मैंने अपने investor को 2x करा दिया. 2x might be, I'm sorry to say, the worst thing that somebody may want to hear. But maybe 2x in 3 months, मान लो, at least IRR तो ठीक लगेगा. But let's say कि 5x कर दिया, 10x कर दिया, 15x, whatever be it. I'm sure that the numbers may be even more astronomical. That public market dinosaur like people like us may not really be able to fathom. But the point is that, that seems to be a very high point, and people get anchored to that. saying that. Now, let me give you how a public market investor or a public market journey goes for any of these companies. Okay. Point number one is that in public markets, there is a buyer and a seller on every single day. Okay, it is very important for people to understand this, that there is no single price to which you can be anchored saying that ki maine isko 3x kar diya, 5x kar diya, 10x kar diya, right? Because every day there is a marginal buyer and a marginal seller, right? Now, what happens is that over the period of time, okay, you will have different people in the cap table at different price points. Okay, right? Now, so I've done this exercise sometime, I think about 2 years back. And we still use this for some other work, but it's not necessarily only for startups. But what we do is that, we take all the companies which are listed, okay, the top 1,000 companies. We don't go into the penny stocks, etc. at any point of time, right? And then we say that, मान लीजिए कि somebody bought a stock at, say, January 1st, 2000, okay? We say that what will be the return be 5 years from that, okay? So that is one data point. Okay. Similarly, January 2 to January 2, 2006. That's another. So like that you will get a series of 5-year data points, right? Now, in this series of 5-year data points, if we see at least 50% of those dates, so from 2000 to 2025, let's say there are 25 years. So 25 into 250 trading days. So that many number of such data points will be there. Okay. If we see that 50% of the days, you have not even made, say, 0% return. Is it possible? Of course, with every stock, there will always be some days or some amount of time where you will not make any returns. It happens with the best of companies. I mean, especially if you buy it at the real high valuation, etc. So you can always get that. But when you are saying that you're not even going to make 50% of the time, even 0% return, you are going to be left with a very disgruntled shareholder base. Right? Because people are going to vote with their feet. Now, whatever, be it a public manager or a normal investor, at the end of the day, and this is extreme disgruntlement, I would say that, we should at least give them a T-bill rate, a 6% thing. That is the bare minimum that anybody is expecting. Okay. And you'll be surprised to find how many companies actually end up getting into this disgruntled base over time. Okay. The other extreme are the very happy shareholders, wherein you make at least, say, 15% return or 12% return. Again, I'm not talking about very outlandish numbers. Okay, these are the basic numbers that we are talking about. And you'll be surprised to find that maybe not more than, say, 15-20% of all companies actually come up to having a happy shareholder base. Okay, now why is this important? Okay. In the case of public markets, you have to think like a marathon. It is not about point to point. It is not about saying that, मैंने अपने investor को 3x return दिया, 5x return दिया. Because here, you don't know who your investor is. Of course, you will have a cap table. You will know that this mutual fund, this fund, etc. is part of it, etc. But the reality is that managing the expectations of a public market investor needs a very different mindset. Okay, that's one broad point. The second point is that when, let's say an IPO, and I'm not giving out names for obvious reason, but there are many IPOs that have happened of startup companies or of new age founders and very well run companies. Okay, there's nothing wrong with any of these companies. Okay, so what typically happens in an IPO process? मान लीजिए कि a good company backed by very strong founders, very good corporate governance. So no issues on any of those fronts. Okay. Typically, ahead of the IPOs continue to grow at 30%, 40%, blah, blah, blah. So, and of course, the India story is always great in Excel sheets that you can always get 25% compounding till no end, right? And then we see that, stock, the way it is distributed during IPO is what? नहीं सबको थोड़ा थोड़ा बांट देते हैं. That's how it's happened, right? कि मतलब हाँ मुझे सब funds चाहिए. Because the point that people are missing out is that, see, in any fund house, okay, now this is a secret of the fund house that I'm telling you, but while there may be, say, 200, 250, 300 companies in the fund house, because there are multiple mandates, right? There's mid cap, small cap, there is a PSU, n number of mandates are there, right? The reality is that the top 75 positions account for 80% of the AUM of that company. It's a 80-20 rule everywhere, right? Or maybe 75, maybe 80 stocks or 100 stocks. Now doesn't mean that, what is outside of the 100 are bad companies, etc. So don't get me wrong. They will be in different phases of discovery. But the point is that the moment you are part of the tail of every mutual fund house, basically what you have done is that you made yourself an optionality instrument for every fund house. Okay? सबने अपना रुमाल डाल दिया कि बॉस हाँ ठीक है, ये अच्छा है, ये अच्छे बात तो कर लेता है. Because quite honestly, while we all do diligence, we all, we don't apply in everything. The reality is that the amount of data points that you as a private company and as a public company are going to show are going to be very markedly different. Okay. For example, in a public market company, you will be surprised that, there are fraud detection tools coming from annual report analysis. Okay. So if you look at, say, there is a law called the Benford's Law. Okay. I just have to run the Benford's Law through 10 years of all annual reports, and I'll know that which are the numbers which are more likely to be manipulated and which are the ones which are not. Okay. And this is, just so that we have the small digression. This law was what was eventually used to catch Mr. Madoff. When his Ponzi eventually ended. It is that. It's just, it's a very simple algo. It is basically saying that the number of ones will be exponentially number of times the number of twos, will be exponentially number of times number of threes, because we are following a metric system. And so you run it on a lot of numbers, you will invariably find a curve like that. Okay. And anywhere where you don't see that curve matching, you know that something is wrong. Of course, you can then dig deeper, etc., etc. But the point is that, when you're coming in for listing, we don't have any of that. Okay. So the moment you are spreading yourself thin, saying that you're getting a cap table of every mutual fund or of every investor, please understand that you are basically becoming the rumal of every fund house, which is at the periphery of every fund house is where you are. Now, everybody will say that, we are long-term investors and all that. I'm sorry, maybe I'm giving out a lot of trade secrets of what all we end up saying in our fraternity. But the point is this, that as founders, as management team of an IPO-bound company, I always say this: you get the investor you deserve. Okay, if you pander to everyone, you will go nowhere. Because this is not a popularity contest. You need to find 2, 3, 4 people who have some kind of a vision. Of course, being public market, they can always say that, you made a mistake and I move on. That's always going to happen. There's no certainty. But you need somebody to feel for you, to have some kind of a passion that you are bringing into the table. And therefore is a core for them. Right. And therefore, you need to think about doing things very, very differently than what is currently being done, wherein everybody is being given, let's say, 10 crores, 20 crores, 50 crores, whatever, and saying that, okay, sabka cap table aa gaya. That means my listing day gains will be very good because somebody will have to buy. These are all such flawed, you can say, mental models to have in the first place. Right, because you have to think from a marathon. Who the hell cares about a listing day? Is it, it can give you a nice thing that, okay, it's a good moment to have, no doubt about it. You've all learned the right to go ring the bell on NSE and BSE and feel very proud. And we share that. But the point is that the journey beyond that is a marathon. So you will have to think of it very, very differently. You will have to think about a board, which is very, very different from how you used to run it before. Okay. All of these things matter because ultimately, as founders, your skin in the game is very small. Okay. And, as shareholders, we'll vote with our feet. Maybe the first time we will let it pass, second time we'll let it pass. We are friends, we are good. Okay. But at some point, we are fiduciary managers, right? At the end of the day, if I'm going to get disgruntled, then I'm going to vote with my feet. Right. So we don't want any of these experiences to happen to our partners and to our investing companies. Right. Which is why I think you need to have a very good dialogue, not to think IPO as some kind of a super formula that, will get you on cover pages of magazine. Of course, it'll do all that, no doubt. And congratulations. I think you've earned it. But there is a lot more beyond that. You need to choose your investors and partners very, very carefully. So that's the second point. Okay.
Harish,
The
I think
third
on
point-
that one, on the same point, just one thing that, I'm assuming that it's much easier to get, let's say, a tiny allocation from multiple fund houses, and that's why it tends to happen. But if that has to change, right, what does, let's say, a startup need to do? Does it mean that, that exercise, because as you said, that number of data points are lesser, does that engagement has to start like many years ago, probably couple of 2-3 years ago, so that actually, people build deeper conviction about the business, and then you end up like in the top 75 companies which have or you have significant skin in the game? Is that, or basically you would need more data points, you would need more conviction on backing the company rather than just, having a 1 month window and then finally deciding?
That's
Is
right.
there more
So
to it? Yeah.
yes, yeah, that is definitely to be. But see, I think it is more important to see. Growth is the startup mantra, right? And everybody likes growth. We love growth. I mean, any growth asset appreciates faster than a non-growth asset. I don't think there is any. But growth is like cancer. Okay, cancer is also growth, right? Now, uh, uh, you know. So there is a thumb rule. I mean, I'm not the one to use heuristics, but broadly, if you're going to grow your bottom line or your top line, whatever be it, you're growing your business ahead of, let's say, the return on equity, okay, which is basically return on equity. I'm sure you know what I'm talking about, right? Okay, that means you're going to constantly need external capital, right? Because you need capital to fund your growth, which is good. Okay, but please understand that as I say, sometimes you are the statue, sometimes you are the pigeon. When you're going to constantly need capital, okay, sometimes everybody will come to you. Sometimes all it requires is some banker sitting in Boston to say, no, I don't want this growth. Okay, and this confidence is a very important thing in public markets. You'll be surprised to see, how reflexive various market participants are. And if you don't have access to capital, that is the ultimate death knell for you. So therefore, especially when you come into capital markets or into public markets, you need to be in a stage where you can demonstrate growth without needing significant doses of capital, which is why the importance of unit economics, which is why the importance of ROE. And it's not about adjusted EBITDA, it's not about adjusted this, that, and the other. It has to be actual cash that is coming in, from your business operations, that is good enough for your growth. And of course, there'll be phases when markets are extremely buoyant, and wherein we will make we'll give you more capital, right? But that cannot be deemed as your birthright. Okay, please understand this. The third aspect, and this is slightly more macro. Sorry, you had a point.
No, Harish, I was saying that you made an interesting point that, unit economics is important and you should not become a capital guzzling machine. But there have been like businesses, let's say Uber, which got listed in US, which required billions of capital. Is it fair to say that, building those kind of businesses and getting them listed is a hard one, considering that you're going to require a lot of capital to build out that market and, getting yourself listed, or what we are seeing in the quick commerce play, that, these companies are listed and now are trying to create the market, or create the category in sorts. It's hard in our country.
Yeah, so see, the reason why Indian equities have done so well, it's an interesting point that you bring about growth, and I just want to, sorry, I'll just come back to this, but I want to make that point of cancer, right? See, we've seen Chinese growth to be astronomical, right? They've been off the charts. There's been no country in terms of economic growth that China has done ever, right, in the last 100, years. And yet, when you look at stock returns of, say, the MSCI China over 30 years, okay, they've made 0% return compared to India. Now, the question is, why is that translated into 0% return despite all of this growth? Okay, and you'll be surprised to find that the single most reason, okay, apart from the vagaries of policy making, etc., it's just that the dilution of capital for that growth has eaten away all the returns that an existing shareholder has gotten. That is the bottom line of it. So there is this paper that I have written, I mean, as a side note, which explains this entire thing. It's there on my Substack. So So basically, let's take, say, indices, just to make it simple. And it's a combination of all businesses, blah, 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 right? Now, index, every day when you see an index, it's basically computed with, say, an index value, which is the outcome, right? Sensex is so much, Nifty is so much. But the way it is computed is basically the values of each of these stocks, okay, and the particular price. So there is something known as the index divisor, okay, which is basically what the values are, right? Now, whenever there is a change in the index composition, you don't, let's say a very high price stock comes in, you don't see the end value change because of that, okay? The index divisor does that adjustment in some sense to get you that. I'm simplifying it. Now, index divisors change either because of frequent churn, okay, or it is also about, let's say, you dilute yourself and you raise money, okay. The price doesn't change, but the market value changes, right? Because you're diluted. That actually increases the index divisor so that the overall equation remains the same, okay. Now, so if you look at the CAGR of MSCI China, let's say, okay, what you see is that the market cap of MSCI China is not that it has grown at 0% CAGR over 30 years. It has grown at the same, in fact, a higher rate than the GDP growth. Okay. So there has been a significant amount of market cap increase, right? But that has all gone into that index divisor because you're constantly kept diluting capital. As much, if my memory serves me right, they've diluted capital by some 11% CAGR over those 30 years. Okay, so whatever has been your market cap increase has basically gone away to all the constant dilution of capital, right? And of course, there have been changes in index and all that. So the point I'm trying to say is that if you're going to constantly need capital, you are one is, of course, A, you will have to be lucky to keep getting it at every call. B, you're going to impact the existing shareholder base. There's no doubt about it. Even as a unlisted firm, you all will understand this, right? Each time you get in capital, your own stake comes down as founders, and therefore, your value potentially can come down. Of course, the idea is that this new capital brings in that growth to more than offset that thing. But there's a point in time when this no longer works. Right, you can make this TAM and all these projections, etc., to justify that valuation. But when the hard cash doesn't come through, and when there is a challenge on that growth assumption, your end value will be much lower with a lower value of your initial share count, which means which is where you are. So that is what I meant by the fact that one shouldn't be too enamored by growth. I mean, we love growth business. Again, don't get me wrong. It's not that we are saying that you don't grow. I mean, we're buying you so that you can grow faster. Now, how much is that extent of overgrowth or extra growth is what we are quibbling about. That make it reasonable. And that can only happen if you've got your unit economics right that don't burn capital. So you need to get. So coming to your point, Chirag, that, can we have, therefore, such huge capital intensive kind of businesses? So I have a slight hypothesis and theory. Okay. And which is again something that I think founders like yourself may find it interesting. See, what we have today is we have a problem of plenty, actually. Okay. Why do I mean by that? See, if I look at the total cash flow from all the listed companies, how much cash they generate every year, that's roughly close to about 15 lakh crores. I may be a bit off, but that's a magnitude. Okay. Roughly about $200 billion, let's say, is the every year cash flow. Okay. Now, this cash flows can be used in broadly two ways. One is to give dividends, okay, to the existing shareholders, and second is to reinvest in their businesses, right? Now, dividends are, unfortunately, Indian businesses, barring a few, don't really believe in giving back capital as much as we've seen in the Western world. Of course, it is changing that also, but by and large, barring the IT sector, we haven't really seen that, right? So, which means that reinvestment is their biggest source because they believe that they can keep redeploying that capital and get a bigger value creation going forward. What we are seeing is that the actual investment on the ground is close to about 10 lakh crores as we speak. And this 10 lakh crores used to be 6 lakh crores pre-pandemic. So we've seen an improvement, but we've seen almost 5 lakh crores of additional amount of money that the old age listed companies are throwing. right? Now, this has to go somewhere, right? So what I'm saying is that, for a lot of new age businesses, the actual starting point of a new age business was actually in the olden days, maybe something like a DuPont. Okay, wherein they would create a business within their thing, saying that because I'm not going to look at you P&L, अगले 3 साल के लिए जो करना कर लो और फिर then we'll see it, right? Conglomerates are the actual starting point of all startups, if you think about it, right? We'll get back into that same loop. Okay, it's another thing whether they'll be successful in running a startup with a mentality, mindset, and all that. That's a whole different point altogether. Or maybe they'll also just start up a fund to say that, okay, I'm going to let you do it. But then we are going to see a lot of marriages happening on the right. I mean, we had seen, for example, one of the largest FMCG players buy up a startup recently, right? And I would think that this will continue. I mean, I'm not saying it's a good thing or a bad thing, but when I see the numbers, I see that. Right. So therefore, it is not that everybody's exit needs to be an IPO, right? Because an IPO comes with its own mind space, which is very different. Which a founder, a founder has to really think about it. That is that what he's wanting to do? Because see, all your partner investors will go away. Ultimately, it's going to be the founder who is going to be answering to all the shareholders. Okay, and we are benevolent, we will give time, we are patient. It's not that we're going to put a gun on you every quarter, etc., right? But there is a limit to all of it, and therefore value creation has to be the single most important objective, with integrity, with ethics, with time, in a more capital efficient manner. If you can achieve that, I think that can be a phenomenal amount of value creation. I wouldn't be surprised to see $1 trillion companies coming out of startups out of India, maybe in under 15, 20, 25 years. I think the opportunity is there. There are some great companies, some great management teams. All of that is there. It's just that they have to keep their heads cool, think about the marathon. Because a lot of founders may get burnt out. I mean, it's not easy, right?
Yeah.
So you have to think of creating an institution. If you can do that, I think public markets will love you. We will love you, I can say for a fact.
Yeah, I think one of the things that we have, at least I'm now hearing is that don't wait. Like you're right, because a lot of companies who are startups who want to IPO are venture funded. They want to give a 2x, 3x, 5x return to their current investors. So ramp up the valuation at listing significantly. And a lot of public market investors I've heard is, like yesterday, Rohit Bansal at Snapdeal and I were having a conversation. He like, थोड़ा तो गन्ने में जूस छोड़ दो यार, like leave something on the table when you bring it. And he was saying कि तुम थोड़ा जल्दी जाओ, तुम 10,000 करोड़ पे क्यों जा रहे हो पूरा, तुम why are you going so late? फिर तुम your 10,000 crores is where the market starts. तुम 2,000 करोड़ पे जाओ ना, 2-3 हजार करोड़ में जाओ. Then I said at that low valuation you don't get interest from large investors. He said नहीं, वो ठीक है, you build that as a public company. Quarter on quarter, you keep building it and you keep kind of growing, keep showing more and more robustness in the business, and let the people who come in, treat them like risk investors almost. They came in early and then they're able to take it from, let's say, let's say a 600 crore top line business generating 60 crores of EBITDA, lists at level 2,500 crores, right, in the consumer space. I think तुम उसको ले जाओ ना फिर 5,000 करोड़ तक, instead of saying कि I will kind of really kind of take it maximum and then you start struggling.
No, so yeah, I think there is a misnomer to think that public market are not risk seekers. Okay, but the kind of risk that we are seeking are different from the risk that early investors, etc. All said and done, investing is a probabilistic endeavor. Okay, what public market investors are not wanting is to bet on binary options, which can go to zero. So that risk we are not taking, or so we are very clear that that is a risk of a early stage angel or maybe a venture cap. I don't even think private equity can get there, but maybe I'm wrong. I have only operated in public markets. But so now whether it should be 2,000, it's not got nothing to do about a particular market cap to say कि बस यहाँ से growth नहीं होगा. See, we don't need a growth of 100% every 2 years or 3 years. Okay, that is not what we are in at all. I mean, we would love to get it. I'm not saying that we will complain, but the reality is that as public market investors, we are marathoners. We want to partner good companies which are differentiated. And that's the point I actually forgot to say, that instead of growth, what we really look for are differentiated people or differentiated business models, that is growing their market share. Now, of course, when you're growing market share, it is coming at the expense of somebody, maybe the kiranas, maybe the old school, etc. But the point is that you need to actually explain, or you need to kind of demonstrate an evidence that how you are different. Where is it? What is that insight that's making you different? Because essentially, I'm taking a bet that you will continue that differentiation strategy going forward. Right, that is a bet that we are talking about, and then it is no longer about कि consumption slowdown होगा नहीं होगा, because those curveballs impact all our other companies also. It is not that it's going to impact only a startup. Yes, because you were growing at 30%, a slowdown, if it impacts and comes down to 15%, it can mean a very meaningful delta to valuations for you. But the reality is that we understand that you can't continue to keep showing steroidal growth. And we're not going to penalize you. But then your basic DNA, you should never change, which is that you're thinking hatke. You are doing things different. When you do that, and when you keep demonstrating value add that you can bring in to your customer, market will give it fair value. As simple as that. So because it is that differentiation that ensures the sustenance of that ROE over the cost of capital. Yeah, nothing else will ensure, because if and I'm sorry, I'm kind of taking a very different topic. It's like, say, renewable sector, okay, where it's a great sunrise sector. There's nothing wrong about the sector. TAM is huge, blah blah blah, energy requirement. But if all your sources of inputs are the same, your cost of capital is same, you're buying from China or from wherever, your installation, you're leasing out land, where is the source of differentiation? What will eventually happen is that returns will come to the cost of capital. Because somebody will say, nahi, ye margin nahi mil gayi, itna margin kafi hai, itna kafi hai, itna kafi hai. When you do that, you're never going to create everlasting value. Right? So that differentiation, I would say, is very, very important for us as to what is it that you're differentiating by, what is giving you that extra source of return, and can that sustain? I mean, at least that is the way we think as public market investors. I'm sure markets are made up of all kinds of individuals. This is our thought.
Are you seeing that getting better and better over the last 3-4 years as some of these
Absolutely.
companies? Like, are you seeing management teams become more mature, more reasonable with expectations, more differentiated with their offerings, or are you seeing it kind of go up and down? Do you see market improvement in the way companies are thinking about?
So I think bull markets are the bad time to experience these, because everybody is in a hurry. तुम नहीं तो कोई और दे देगा. Why should I answer you all these things? It's a fact. I mean, I don't. And ultimately, everybody wants to give an exit to their investor. So the investor is doing all the work. He is deciding, किसको जाना चाहिए, ये मेरा दोस्त है, etc., etc. Right? I think in bear markets and tough times is when the true character of the company actually comes through. Good times, both for investors as well as for businessmen, right? Good times are a poor character. I mean, but has there been a greater awareness of it? Like Chirag, what you said, we know many companies which are now starting their outreach, maybe say 1.5, 2 years before their IPO, to get some understanding in, etc. But it's still, I would say, very primitive. But we need to start seeing this happen more and more, because it's not that we should not be being thought of as an end destination of investor. We should be co-creators. I mean, we are also giving you risk capital, just that we are giving you a longer runway of risk capital. So it's the horizon that is separating us more than the ability to take risk.
Oh, and interestingly put that, one big differentiator is that you are not looking at taking binary risks, right? Which is where the world changes. Even if you are compounding slowly, that's fine. Even if you are not chasing that 100% year-on-year growth, that's fine. As long as, there is a source of differentiation, there is compounding, which is happening at certain level. Then as a public market investor, you have patient capital to wait out for years. In fact, you would maybe, I think what I have learned today is that it's a different playbook, and we need to adopt to that playbook, unlearn the existing playbook and get to the new playbook, right? That's where it gets down to.
I don't know whether that'll be maybe too harsh. I don't think I have any such thing to say that you have to unlearn something. But the point is that please think of us as partners for the long term. Okay, and I'm not saying it just as it sounds nice. I'm sure everybody with capital says that, right? We are long-term investors, blah blah blah. But I'm saying as public market itself, see, it's not that we are looking at an exit. That's the biggest difference compared to others, right? Any investor who's coming in is coming in with that end game. I'm telling you that I'm not coming with that end game. I would rather be with a company that can keep compounding for 100 years without any end target. It's a very different. So it's a marathon game. That is the big difference, right? So therefore, while we may seem different, I mean, we will not be part of your boardroom discussions, etc. Okay, but we do bring in a lot of value in terms of these dialogues to try and channelize how you can create long-term wealth, long-term value for yourself and for the company and all the shareholders, stakeholders. Well,
Superb.
Very helpful. I think so many things to learn, right? One is think of it as a marathon. Public market investors do look for risk, but look for measured return on capital over a long period of time. I think what you spoke about management teams who are differentiated in their offerings in their businesses, I think is very valuable. Also, I think a lot of startups have each investor represented on the board. That's how all our boards are constructed. It's actually a very bad way to construct a board.
yes.
It should be the board should be independent
So,
of.
on this, I mean, it's good. I forgot because I keep telling this. I mean, advising is the wrong word to companies who come in. Please change your board even before you come, and get people who can question you, not from an investor point of view. Of course, shareholders have their own rights, but because especially in startups where the skin in the game is so low to start out with. Okay, you need to get some very, very strong board members on your board who are going to challenge you. It's a good thing for you. It's got nothing to do with saying having a compliant board at all. Get challenged so that they are being fair to the minorities also, right? And when you do that, you create a wonderful, long-term institution. Sorry.
Fantastic. I think so many things like for I don't know, GoKwik, Mosaic, Bombay Shaving Company. All of us kind of we do dream about taking the company public and having our shares being traded by of course institutions like yourself, but also like the average common investor in India. And I think frankly, I think it's a massive brand building effort also. Like I think if thousands of people are trading your shares, then
So therefore, you shouldn't have them as disgruntled. That needs to be your comment. See, forget about me. If you do this exercise and you think about the common person who is buying it every marginal, and you give them a 5-year thing, okay, that doesn't really happen. People are still short term. But I'm saying 5 years, which is why, see, I'm saying India's best private sector bank, which created so much of wealth, okay, last 5-7 years hasn't been. And yet you have shareholders backing them. Why? Similarly, you can think of other institutions which may have had a great 2-3 years, but who have seen, say, 15, 20 years of misery. And you will see that, shareholders are very, very afraid to put capital, meaningful capital there. I mean, turnarounds can give a lot of returns, but then can you actually allocate so much capital out there? Okay. So therefore, if you, I mean, it's like, I mean, very philosophical. It's like Mahatma Gandhi saying that think of the commonest or the poorest man in your decision, and you'll make all the right choices, right? I mean, I'm paraphrasing. I don't know the exact quote. It's not coming to me. But if you think of the average retail investor and think that on a 5-year you want him to be on the happy side, I think everything will fall into place. There's nothing else that you need to think about.
That's fantastic. I think for me, this is an IPO playbook, and I'm so grateful to Revant for introducing you. I'm going to definitely come and one-on-one tickle your brains on how we should think about it specifically also. But what a wonder! And I think for all our viewers of Asymmetric, if you are starting a company, if you're running a company which you have IPO dreams, I think just think of it as a milestone and not a destination, and then how to build for the decades once the IPO is done, I think is a big takeaway for me personally. So Harish, I know cognizant of time, we are 3 minutes past, but thank you so much for taking the time, and I really hope that you keep coming back on the Asymmetric podcast. I hope we're able to, all of us and our viewers are able to keep gaining from your perspectives.
No, I absolutely love the conversation. This is very close to my heart, and so which is why when Raven said, I also kind of jumped into it because I really do think that founders can contribute a lot more to public markets. We can gain from a lot of such wonderful entrepreneurs and businessmen. Just have to kind of hopefully align our interests together. And to have a wonderful partnership. So I'm so thrilled to be out here. And looking forward to all the conversations that we'll have on the side.
Thanks.
Amazing.
Thanks, Harish. Super. I think the reason we started Asymmetric was one of these things that, we get guests and we get to learn a lot. And then, of course, our viewers. So I
No,
think
I get to learn as
10,
well.
10 on 10 in terms of the new topic. And
Yeah.
at least I can tell you from my side that it's been 101 playbook for me today. Lots to
Same.
learn. It's been an eye-opening discussion.
Seriously, eye opening and a lot of counterintuitive things. I just love the way you spoke about risk appetites, allocation, and even like the way I think the way you and your brethren look at macro global global geopolitics and macro indicators. It's just amazing to learn from. So thank you so much for being so generous. Really appreciate it.
Thank you so much.